Here's what nobody tells you. Right now, your structure is either quietly building wealth for you or it's bleeding tens of thousands of dollars every single year. And you don't even see it happening. Over the past 13 years, I've reviewed the financials of hundreds of Australian business owners, and the pattern is disturbing. 8 out of 10 people are in the wrong structure. Not slightly wrong, wrong enough that it's costing them a house deposit every 3 to 4 years. So in the next few minutes, I'm going to show you the 4-factor framework that determines whether you're in the right structure or quietly donating money to the tax office every year. Then I'll reveal the insider strategy for switching structures at exactly the right time without triggering capital gains tax. And finally, the 3 traps that get people audited when they try to restructure without proper advice. This isn't theory. This is exactly what separates the business owners who build wealth from the ones who stay stuck working harder for less. Let's get started. Before I show you which structure to use, let's do the math on what the wrong structure actually costs. Say you're running a business making $300,000 in profit as a sole trader. You're paying personal income tax on that entire amount. At that income level, your marginal tax rate is 47%. So you're paying roughly $107,000 in tax. Now, if you structured it as a company from day one, the company pays 25% tax on that $300,000. That's $75,000 a year in tax. The company keeps $225,000 after tax. You still need to pay yourself, of course, but now you control when the funds are released and how they get paid. You might take $120,000 as a salary, paying around $30,000 in personal tax on that. That leaves $180,000 still sitting in the company, which gets taxed at 25%. That's another $45,000 in tax. The total tax, $75,000 instead of $107,000. That's $32,000 in tax saved in 1 year. But here's where it compounds. That extra cash sitting in your company after you've paid yourself can now be reinvested into the business at the lower 25% tax rate, or it pays down business debt, or it sits there building equity that increases your business's value when you eventually sell. Over 5 years, we're talking $150,000 to $200,000 in additional wealth just from picking the right structure early. So how do you actually choose a structure? It comes down to 4 factors. Factor 1 is risk. The first question is, what happens if something goes wrong? As a sole trader, there is zero separation between you and the business. If the business gets sued, you get sued. If the business goes broke, that means you're going bankrupt. Your house, your savings, your personal assets are all on the line. A company is different. A company has its own legal entity. If the company gets sued, it's the one being sued. If it goes broke, the company goes into liquidation and you walk away. Your personal assets are protected. There's an exception here, which I'll cover in the red flags section later. But in general, if you're hiring staff, dealing with customers on site, or operating in any industry with physical risk, you need a company. Factor 2 is profit level. The second factor is how much profit you're actually making. If you're brand new and you're making $50,000 to $80,000 a year in profit, companies cost more to operate, so you'd be better off staying as a sole trader and switching later once you start making more money or you need to hire people. But once you're consistently making over $100,000 in profit, and especially once you're above $150,000, the tax benefits of a company become significant. That's the point where you should absolutely be in a company structure. We're doing this right now with a plumber named Tom. He's a sole trader. His business is growing and he's just hired his first apprentice. After speaking with him, it was clear he needed to upgrade his structure to a company. Who you need to pay. The third factor is who else can you distribute income to? If you've got a spouse, adult children, or other family members who are on a lower tax rate, a family trust gives you the flexibility to split income and lower your overall tax bill. Let's say you make $300,000 in profit. If you're a sole trader, you're paying close to $107,000 in tax. But if that profit sits in a trust, you can distribute $100,000 to yourself, $100,000 to your spouse, and maybe $100,000 to 2 adult children. Now you've spread that income across 4 people in lower tax brackets. Your total family tax bill might drop to $60,000, and that's $47,000 saved from just having the right structure and the right people to distribute to. But here's the catch. If you're in a personal services income business like consulting, IT contracting, or certain trades, the ATO has rules that limit your income splitting. So you need to talk to your accountant about whether PSI applies to you. Factor 4 is business expansion and scale. Are you planning to scale or bring in partners? If you're building something you want to grow beyond just yourself, structure matters. A company makes it far easier to expand because you can bring in other owners, offer shares to employees, or raise capital from investors. With a sole trader or a family trust, no one can own part of your business. It's just you or just your family. But with a company, you can sell shares, issue equity to key team members, and attract outside investment. We're working with a client right now who is looking to bring in a key team member as a 4% owner in the business. There's a few steps to go through, but importantly, they have a company structure in place to enable this process. So if you're seriously about scaling, hiring a team, or eventually bringing in partners, a company structure is the only real option. So those are the 4 factors: risk, profit, people to pay, and expansion plans. Now, let me show you the insider move that changes everything. Here's the multiplier that most basic structure videos never mention. You don't have to get it perfect on day one. In fact, starting simple and upgrading later is often the smarter move. The ATO has something called the Small Business Restructure Rollover. It lets you move assets from a sole trader into a company or trust without triggering capital gains tax, as long as you meet certain criteria. So here's the strategy I recommend to most clients. If you're just starting out and profit is under 100,000, start as a sole trader. Keep it simple, minimize cost, and focus on growing the business. But as soon as you hit that point where you're making over $100,000 consistently, or you need to hire your first employee, that's your trigger to switch to a company. If you've got a spouse or family members you can distribute to and you're making over $200,000, that's when you look at adding a trust structure on top of the company. The key is knowing when to switch, not trying to predict the future when you're still at 0 revenue. And if you time it right using the restructure rollover, the switch costs you almost nothing in tax. Start simple, then upgrade at the right trigger points. And use the rollover rules to make the switch tax free. So you know what structure you want to aim for. Now, let me protect you from the 3 biggest traps I see people fall into with structures. Red flag 1, thinking a company means 0 personal risk. A company does protect your personal assets, but only if you follow the rules. If you're a director and you trade while insolvent, meaning the company can't pay its debts, you become personally liable. If the company doesn't pay its PAYG withholding or superannuation on time, the ATO can issue a director penalty notice and come after you personally. So a company isn't a magic shield. You still need to run it properly. Red flag number 2 is setting up a trust without checking the PSI rules. This is huge. If you're a consultant, contractor, or in a certain service industry, the ATO's personal services income rules can block you from splitting income through a trust. People set up a $3,000 trust structure, start distributing to family members, and then get hit with an ATO audit that reclassifies everything back to personal income. Now they owe back taxes, penalties, and interest. Always check the PSI rules before you set up a trust for income splitting. Red flag number 3 is DIY restructures. I've seen so many people try to move from sole trader to a company themselves using an online template. and they miss the rollover election. They don't transfer contracts properly. They trigger capital gains tax accidentally. A restructure done wrong can cost you $20,000 to $50,000 in unexpected tax. A restructure done right costs you nothing. Get proper advice. It's worth it. Once you've got your structure sorted, the next step is understanding how to actually pay less tax within that structure. And I've made a video that walks through the exact strategies we use with our clients to legally minimize tax in a company structure. But if you want us to sit down and actually map out the right structure for your specific situation, book a call with us. We'll look at your numbers, your goals, and your family situation and tell you exactly what structure makes sense and when to make the move. Links in the description. I'll see you in the next one.